Hi everyone, I'm Yash Poddar, Chief Investment Officer of the Yash Poddar Single Family Office. Our family, to give you a brief background, our family, before we got into the investment world, the promoters of Ashirvad Pipes, a world-leading CPVC manufacturing company based out of Bangalore. And our business underwent a joint venture, which we exited successfully in 2018 as the largest CPVC manufacturers in the world. Post 2018 is when the family office was set up with the sole intent of managing and preserving the family's wealth. I represent the Yash Poddar family office, which is our division of the family. And a little bit about myself, I have spent a good amount of time working in the financial world myself as an analyst, covering listed equities here in India. I also have spent time with working with early stage venture capital companies in India as a company analyst. That eventually led on to my journey of setting up the family office in a fundamentally institutionalized manner. And today we, as a family office, are exposed to asset classes across not just India, but also the globe. We look into equities, listed equities. We look into debt, venture capital, and private equity as well. I head the operations of the investment side. We operate with a small team based out of Bangalore, and we are always on the lookout to participate in the business that are going to be the wave makers of tomorrow. And more relevant to today's panel with regards to technology, we have a very open mindset, and we did our first tech investment back in 2013 through a fund. And over the recent years, we have started to do a lot of deals directly as they come to us as a family office. And we are always on the lookout for an opportunity where a business is able to not only scale, but genuinely create a moat. And that can be as non-replicable, and most importantly for us is, of course, the founding team. And that's kind of our thesis for any investments that we do is we have a super long-term perspective. And yeah.
Yash, maybe the next question is more apt for you, given as a family you invest in a lot of venture capital yourself. What are some of the best practices for investing in technology with venture capital? And secondly, would you rather recommend someone invest directly or via fund, and why not?
Yeah, thank you. I think I'll do the first part of some of the best practices. The best practice that I've actually seen, we've ended up realizing over the last couple of years is that we must treat technology as just another business as well. I think what's happened over the last many years, to be more specific, over the last 3 to 5 years, family offices have grown and so have their interest to invest in technology. However, somewhere in that process, due to the overexcitement with regards to technology and startups that are emerging from places like deep tech, a lot of families and investors, I feel, are overlooking some of the business fundamentals of the tech startups. And this, for me, was a realization, what we realized when we saw a lot of deal flow coming in, especially in the last 2 years, that a lot of these things are exciting on the surface, but can you evaluate them as a business? So that's the best practice number one, that you really got to have your business thesis set, that as a family office, if this technology investment falls within your ambit of what you define as a good business, only then and then you must be able to filter it forward. And you must avoid going from step A to step Z just because you find an opportunity either too exciting or too good to be true, which is a mistake that we have also almost done. We were on the verge of doing it many years ago. Fortunately, we didn't do it and we learned from it instead. That for me is a key practice. Another important thing that I consider is that a thorough due diligence must be done. No matter who brings a deal to you, no matter who presents a deal to you, it could be a very verifiable and reliable source, and that could be, say, one of the filters. But every family office must be aware that these kind of deals are always floated to them forever. These kind of deals are always going to come to families who are sitting on cash. These kind of deals are always going to come to families where a lot of the founders feel that they can get a quick check. And I genuinely feel that families must be able to filter that out, find what fits into their thesis, understand the technology that you're investing into. If you don't do that, unfortunately, that's a bad cocktail for you to get into something which is good as a marketing, and you have been caught then as a marketed product and not an investment anymore. The part two of your question, what you just mentioned about, I'm sorry, can you repeat the second part?
Sure. Yeah. Yash, my question was, for someone who's starting out as a family, would you recommend investing directly or via a fund or combination of both? And why?
So I genuinely feel that the first step that families must do is introspect. Are there fields that we know really well? Are there sectors that we know that we can analyze independently without seeking the help of external participants or too many external advisors? If the answer to that question is yes, then surely go ahead and try to do direct deals in the spaces that you understand. But if there is a sector or space that you do not understand, and I can give a good example, which was for us many years ago, the whole AI and ML space, we made a conscious decision that if we cannot understand the business within 10 minutes of a conversation, and if we have to end up doing a lot more due diligence than we had planned just to understand one investment, that goes into my fund investment category. So I'm happy to outsource that to expert fund managers who are good at their field, who know what they're doing. But it's also important that while I do a fund investment, if I keep climbing up the learning curve during my process of being involved with the fund, then I must be able to try and participate as a co-investor in some of the deals. Because what is the point if we are learning and then we're not applying our learning into an investment? So honestly, there is no real straight-up answer to that. I think it's very individualistic. But I think the most commonly accepted answer would, according to me, be that do a fund, what you understand, do directly. And if you understand something very directly as an expert, please do it directly.
Thank you for that, Yash. Does anyone want to add about how do you ensure that you get the right team and the right idea for investment? How do you measure it? How do you analyze it? And how do you invest in it? Who wants to go? Maybe Yash, do you want to go first? Maybe followed by Vivek?
Yeah, happy to. So when we talk about focusing on the right team and the right idea, a lot of it comes from purely being able to monitor something that has been invested into and actually measuring whether certain milestones have been achieved or not. I think this is another area where a lot of family offices do falter because they either don't have the resources or the team that is able to monitor an early stage investment. So how does the CIO or the family principal really derive confidence at a later stage that, let's say, and I'm going to allude to what Sunil mentioned earlier about certain aspects being understood and then coming in at a later stage, which is absolutely right. So how can any family or a principal or a patriarch be able to, or a matriarch be able to get into a company or invest more at a later stage if they do not monitor the milestones? So that for me is a key aspect. As far as a right idea is concerned, I genuinely again feel that it's how much of a pulse are you able to catch of the market. And this again boils down to, as a family office and more importantly as an individual who is viewing a certain market, how much are you in the ecosystem that you're able to gauge the demand of a product or a service or a SaaS product for that matter? Who are the end users? Are you able to interact with that ecosystem and derive some kind of an actionable data that gives you enough conviction? Because at the end of the day, a family office is always about the family's wealth, and it's not about having 5 professionals come and take charge of your funds. So unless you as a family cannot derive that confidence by going out into the market and say trying to talk to the ecosystem, which could be stakeholders like suppliers, purchasers, the VC funds themselves, maybe say certain analysts who cover the sector. If you cannot gauge that, then you have missed the team as well as the idea. So I feel a lot of this, the best way according to me to answer both these aspects is how much can you keep tab of these things.
Fantastic. Thank you, Yash. How do you assess the risk of a bubble forming in private tech investments? How do you know when is the right time to continue to invest and when is the right time to get out or pause your investing and wait for some markets to correct, some valuation to come in line? Who would like to go first? Yash, do you want to start? Or
Yep, happy to take this one. So I think when we talk about valuations, one has to look at the whole market in entirety. When I measure valuations in the private equity space, and we have seen a lot of massive deals happening in the last 2 years, valuations rising through the roof, probably higher in the private market than the public market. I think one has to be able to view the business valuations not only in the private equity space, but also in the publicly listed space. That is the only way that you're going to be able to draw a whole picture of whether a sector is valued or a company is valued. Let me give you a basic example. For example, edutech. We have seen the larger giants emerge from edutech and who are, say, continuously growing their valuations in the private equity space, acquiring other companies too, and hence growing their base. But at the same time, we are also seeing the other set, the non-polarized names who have not really grown in valuation, but continue to be in the first, say tier 2 or tier 3. So in every sector, there are companies that are overvalued, medium valued, and undervalued. And I think this is true for all sectors. So a bubble usually assumes that this is a widespread phenomenon, but I believe otherwise, that the bubble is actually limited to a specific set of companies within a sector. Another aspect about mitigating a risk of a bubble forming, at least from a family office perspective, is that, like any good investor, and this is a rule that we follow internally, of course, we set timelines to our investment. So if I have done a tech investment today, we mentally set across a timeline which we discuss in the IC. Let's say it's a 5-year investment. So no matter what happens, at the end of the 5th year, there's a 99% chance that we will exit that investment. This is, according to me, the best way that family offices, where the main objective is that of wealth preservation first and then along with growth. I think for family offices like that, the first objective is that how do we take out temptation? How do we remove greed? And how do we stick to our timelines and make our money and get out? And the whole risk assessment of a bubble immediately becomes less important when you have already figured out your exit strategy. So these two, according to me, are the key aspects to understand a bubble in tech investments.
Yash, do you want to come in at this as well? A few lines?
Yeah, maybe? I think when we talk about the exit scenario of any tech investment or any investment for that matter from our perspective, we usually try to decide our exit strategy before we even enter. And that's something that we started off initially with. A lot of our investments were in the private market done with the perspective that let's get into this and let's go with the flow. And that's sort of what we went with for some of our investments, which we are okay to hold over a long horizon, because for a family that is creating wealth out of financial assets, it's more important to achieve that yearly return that you have targeted than sometimes figuring out when you want to get out. So while that school of thought still exists, however, for tech investments and very strategic investments, we really try to keep a threshold where we say that, okay, if something is a 5-year exit, then are we assuming a probability of an IPO, or are we assuming the probability that there's a buyout? And what are some of the main thoughts that go on in our mind at that point of time are primarily to do with not about the return, but how much of the journey has already unraveled. If we feel that a lot of the knowns and unknowns have sort of converged, and there is not, say, much juice in terms of further valuation growth, which we do see today in late-stage startup deals as well. After a certain point, the 10x becomes a 5x, which becomes a 2x. And by the time it gets closer to an IPO, it just becomes a 1.5x. So what that does is it makes you rethink your entire strategy at the later stage, that is there still enough juice left? If we make a conscious call that we have got the returns that we achieve, and at the same time the juice has sort of come out, we are okay to come out of it. And there could be times we're proven wrong as well. However, it's a very objective-based approach that we follow.
Fantastic. Thank you for that, Yash.
There is one part I just wanted to touch about fintech,
Please. Yes.
and this is because as a family investment company, we have also evaluated various deals across things like say P2P lending, say personal financial planning, penny investing. These are so what we've actually come to the realization is that while fintech has a broad spectrum of growth, but some of the more mainstream avenues within fintech, such as payments or say neo banking, are going to have a lot of regulatory oversight. So I feel that the excitement there has already peaked, but I think that there is a need for moderation in fintech because when the regulatory oversight comes in, and it will, there will be new laws written, there will be new codes written, and that could potentially have some sort of a tempering of valuations. However, when we talk about fintech's non-mainstream products like say wealth management or advisory or robo advisories, I think that is where the growth could be just a slightly little more unhindered in comparison.
Thank you, Yash. Thank you for that. The next question has Yash's name written all over, which is, are you seeing an increasing shift in technology investments by traditional family offices? If so, do you expect this trend to gain further momentum? Yash, how, obviously, you are quite ahead of the game in terms of family offices, but what do you see fellow family offices? Are they watching from the sideline, or are they all coming into the fray and learning from each other and jumping into the game?
Yeah, I think the second part, what you said is right. Everyone is jumping into the game, and I'm not saying that in a good way. I often see a lot of the fellow family offices, who I do interact with regularly. I often see that there is a curiosity, but then I also see that curiosity leading to some actions that are either not justified logically, or some things that are more like a tick mark of completing a quota that, oh, we have to have an investment in technology. So here's a tick, let's just do it. It may not be good, it may not be bad, and sometimes I don't even know, but just to complete the quota, here it is. And this is actually a problem, what I see now, because as tech companies like Zomato and the others are going to start listing, so that's going to change the mindset of those same people that want to get into tech and now would say, hey, let's wait for something to IPO. But why not get into something earlier? Why not increase your capacity of getting into something earlier where the juice is better? So yes, family offices have this sort of mandate now because how does it function, right? I mean, the family would reach out to the CIO or the team and say that, hey, look, we definitely want a tech investment because I think it's cool. And I think that we should have one name. Now, the process that follows after that is sometimes questionable. Sometimes family offices do it very well as well in a very sophisticated manner. I have to admit that as well. However, most of them try to follow an approach where, let's say, if a family office is investing into entity A, then they try to bring together 4 other families into the same investment so that they can build a consensus. Now, this is usually how they get into tech together because that is the only way to bridge the gray area of the risk return aspect of getting into an early tech. So I see that happening as well. But the question really to understand is how many of them really make a successful exit with money in hand. That for me is a better metric to understand than family offices being interested in tech. Another phenomena that I do observe is that there is a renewed interest in trying to get into smaller and smaller ticket investments. However, many times I get a feedback even from the founder community that family offices are often difficult to deal with, or that their requirements are very high, or that they may not get a strategic benefit. But I would like to reverse that thought and say that family capital is in fact a lot more patient and a lot more, giving if the startup and the family builds a good relationship. And so I feel that going forward from here in the next 10 years, I think if that bridge can be gapped through good investment family offices, then that can create a brand new avenue of growth for startups.
Fantastic. Thank you, Yash.